Hello everyone, welcome to Atomic ACCA's pre-mock exam solving series, and in this video we are moving to question number 2 of section C FM March 2025 exam. So the question is, prepare cash flow forecast for September, October and November for L company, 7 marks. Calculate the forecast quick ratio at the end of the 3-month period in November for 3 marks. So we have a 10 mark numerical question over here. So let's start preparing. L company has several subsidiaries operating in foreign countries, and these subsidiaries look after their own financial affairs. So it's a large company and in different foreign countries. Okay. L company has recently experienced cash flow shortages in some months and cash flow surplus in other months. Company is therefore keen to improve its cash management. L company is preparing cash flow forecast for September, October, November. Due to their financial independence, forecast will ignore the cash flows of the foreign subsidiaries. Okay, so this is only about that L company. Forecast income and expenditure information has been prepared as follows. So we have information all the way from July till December for sales, labor cost, fixed cost, and depreciation. Depreciation anyways is not a cash flow, so you don't have to bother that. All sales are on credit. Okay, all sales are on credit, and 40% of the receivables pay after 1 month. Okay, so June sales you will get 40% in July, 50% after 2 months, so that will be in August, and the remaining paying after 3 months. So 40 plus 50 is 90, so 10% will come in September. So you have to prepare a sheet like this. Okay, all purchases are on 2 months credit, which is purchase in this labor fixed cost. Okay, that is different. All purchases are on 2 months credit. Purchases are made in 1 month in advance of sale. So if July sale is over here, it is made 1 month in advance, that will be in June, and it is on 2 month credit, which means the cash flow will happen in August. So we have to first see what all are the purchase amount, then we have to sort out the cash flows which is going to happen 2 months later. Then the average margin achieved is 60 percentage. So if they're getting a margin of 60%, that means 40% should be the cost, so that will be the purchases. So this is about purchase information. Fixed costs are paid in the month in which they are incurred, so that is fixed cost. Okay, that is happening in the same month. 80% of the labor cost, okay, that is this one. 80% of labor cost are paid in the month, while remaining 20% is paid 1 month later. Okay, so if some labor cost is over here, okay, this one is labor cost, 80% in the same month, 20% in the next month. Okay, L company must make an interest payment of 0.6 million in October, so this is October, and will receive a loan of 0.5 million in November, so that is this one. So that's like a one-off event. A new machine costing 0.8 million will be purchased for cash in October, so that is in this October. Okay, L company currently has no short-term investment and has a policy of not investing short-term cash surplus. Company expects to begin the September with an overdraft of 0.2 million. So we are preparing for September, October and November, and they're telling that September opening balance will be an overdraft of 0.2 million. So these are all the information that we have. Now let's start preparing our forecast. So we're preparing A1 right now, that is related to September, October, November cash flow forecast. All right. So first let's begin with the timeline. We'll have a timeline of June, July, August, September, October, November, December, September, October. So these are the timelines we have. Okay. First, let's do the calculation for sales figure. What are the given amounts we have? Sales we have in June is equal to 3000, 2250, 3400, 2900, 3300, 2800, 2 900, 3 300, 2 800, and 3 100. What is the information given on sales? They're telling 40% of the receivables are coming up after 1 month. So cash inflow, uh, cash inflow of 40 percentage when in 1 month. So June figure multiplied by 40 percentage. Same thing I'll copy paste for all the months. So I'll get all the 40% figure. Then they're telling 50% will come after 3 months. So cash inflow of 50 percentage, that is after 2 months. So June figure will first come in August. So equals to June figure multiplied by 50 percentage. Same thing if I copy paste for all the years, I'll get all the numbers, not all the years, all the months. Then they're telling last one, the remaining paying after 3 months. So 40, 50, and last one is 10%. So cash inflow of 10 percentage will come. For June figure, it will be in July, August, September will be the first time it will come up. So 3000 into 10 percentage is the first amount. And if I copy paste it for all the years, this will be our forecast for upcoming months. Now, since the question is asking for only September, October, and November, this is our key area to focus on, and the remaining ones are just I just pasted the entire formula. That's it. It's not needed that you have to create all the other numbers. Only these months are the part of our requirement. So we'll just mark it over here. Okay, these 3 months are key focus. So cash inflows for sales is ready. Next thing we had was about purchases. Purchases. What is purchase information given? They are telling that purchase is made 1 month in advance of sales, and that is 60% margin. So first we have to find out what is the actual purchase happened. So June figure first purchase will happen 1 month before. Since anyways it is like a previous story, we don't have to be bothered about it. Let's start from July. So purchase happened will be 2250 multiplied by 40 percentage. So there will be 900 purchase that's happening. Same thing if we copy paste for August, September, October, November, December. So these are the figures we have. Now this is the purchase happened. This is not the cash flow. Now they're telling that these figures are paid 2 months later, 2 months credit. So cash outflow will be happening for June figure. This 900 will be paid in August. So if I connect this L over here, then it will be August. This is the payment for July. So 2 months, 1, 2, 3, 4, 5, 6. So this is how the payments will be. So 900 will be paid here, 1360 after 2 months, 1160 after 2 months, 1320 2 months, this one 2 months, this one 2 months. So that is also ready. Next they are telling is about fixed cost. Fixed cost they are telling is it will be paid in the month in which they are incurred, and 80% of labor cost. Okay, that's about labor cost. So fixed cost, there is no extra calculation. The amounts will be 375, then 480, 505, 480, 595, 595, 476, and 550. So that is ready. The next information we have is around labor cost. For labor cost, the information given is 80% of the labor cost are paid in the same month, while remaining is paid 20 months. 20% is after 1 month. Okay. First, let's take down the amounts. Labor cost is 680, 500, 705, 690, 735, 305, and 600. Now with the cash flows. Cash outflow, how much? 80 percentage. it is told that it is paid in the same month. So the above figure into 80 percentage, and same thing for all month. Then they're telling the cash outflow of 20 percentage will happen in 1 month time. So the above figure multiplied by 20 percentage will happen 1 month forward. So we can copy paste it for all the years, and that will give the cash outflows that are happening for all the years. Next is about making an interest payment of 0.6 million. Here we take all the sales is done, purchase is done, labor cost we took, fixed cost we took. Okay, all that is done. Then they are telling about some interest payment. Interest payment. And they're telling that is happening 0.6 million in October. So where is October? This is October. So 0.6 million. So all these are in thousands. So this will be 600,000. Then they will receive a loan of 0.5 million, 500,000 in November. So I'll just write it right beside this, 500,000 in November. So this is about loan received. Then they are telling a new machine costing 0.8 million will be purchased for cash in October. So this is October, and that is how much? 0.8 million. So 800,000. This is about purchase of machine. Then they're telling the company expects to begin September with an overdraft of 0.2 million. So that when we are preparing the final forecast, we can use that opening and closing balance and all. So this is the overall situation we have. Now what we can do is we can net all of these figures together and find out what are the cash movements happening in each month, because they want the forecast for September, October and November. So getting on to the main part, cash flow forecast for September, October and November specifically. So if I take these 3 months down, first we need is inflows. For September, what all could be the inflows we have? If we go to the September month over here, sales is an inflow. So these three are inflows in September. Purchase is an outflow, fixed cost is an outflow, labor cost is an outflow, interest payment is an outflow, loan received is an inflow, but that's happening in the November month. Purchase of machine is an outflow. So inflows only this much is there. Now if we take the outflows, now there are many outflows that we saw. Okay, similarly we can take for the other months as well. Let's copy paste this. 3085 3110. So 3085 will be the sum of these three numbers, and in November it will be the sum of these three numbers. Okay, now what other inflow we told about? Loan received. Loan received is an inflow that's happening in November, so we can write over here. Along with this, loan received will be there in November, that is equal to this 500 loan received. So this is ready. Next is outflows. First outflows are coming up in related to purchases. We have some outflows over here. So let's just make it little more neat. This is about sales, then loan received. Okay, about outflows. First is purchase, we have equals to negative purchase cash outflow. Don't take the purchase happened. Okay, purchase cash outflow is important. And which all months? September, October, November. For September, 1360 is the payment, and if we take for the other months, we'll have 1160 and 1160 and 1320. So we have the purchase outflows ready. The next outflows are coming for fixed cost. Fixed cost equals to negative fixed cost is September, there is a fixed cost of 480. So if I take it for the other 2 months, it will be 595 and 476. So that's ready. Next is outflow related to labor cost in September, October and November. So we have two figures to take for each month. Labor cost will be equals to negative sum of labor cost in where is September in this. September is 552 and 141. Similarly, if I take for other months, here it will be the sum of these two numbers in October. Here it will be the sum of these two items in November. So that is also ready. Then we have an interest payment coming up in October. So interest payment coming up in October, that is equal to negative 600. And we have a purchase of machine happening. Purchase of machine, that is also happening in October. So equals to minus 800,000. So we have taken all the figures from the table over here for September, October, November into our forecast over here. Now the total calculation will be like this. Some opening balance will be there. The cash flows or cash movements during the year, it could increase or decrease and will lead to your closing balance for that year. Opening balance and closing balance. Okay. Now what is opening balance? They told company expects to begin September with an overdraft of 0.2 million. 0.2 million means minus 200,000. So minus 200,000 is the opening balance. Cash flows will be the sum of all the things that are happening over here. And finally, if we sum up these two numbers, we'll get a closing balance over here. This closing balance will become the opening balance for next year. Same thing we'll do. What is the cash flows for next year? It will be the sum of all things happening in October. And same thing to do with the closing balance. If we do, we'll get minus 744. That is the sum of these two numbers. Same thing will happen over here. This closing balance will become the opening for next year. Again, we'll do the same thing. We'll add up all these numbers, and when we sum up these two numbers, we will have the cash flows for November. So with this figure, we are completely done with our cash flow forecast for that 7 marks. So this was our final answer that was needed. The other one is basically the working notes. So we can just write title over here. Working notes. Next question we have over here is they want to calculate quick ratio at the end of 3-month period. So B question. So the other one was not A1, it is only A. So B question was asking to calculate quick ratio for November, that is the end of 3 month. Now what is the quick ratio formula? It is equal to current assets minus inventory divided by current liabilities. Now based on the situation that we have here for November, what current assets we have? We'll have receivables, we'll have cash balance as well. So inventory we don't have to consider. So if we just rearrange this, it will be like this: receivables plus cash balance at the end of 3 months divided by what current liabilities we have. We have majorly only payables over here. Nothing else is happening as a, we don't have any tax liability, we don't have any other bank loans, we don't have anything else that is coming up as part of bank loan is there at the end of November, but we'll receive a loan of 500,000 in November. So it's not very clear about whether this is a short term loan or a long term loan. So for time being, we can assume that it's a long term figure, and we can just write in our answer as well, assuming that this loan is long term. It will not be part of the current liability, because if it was a bank overdraft figure, then it will be considered in this numbers. So you can just write as a note over here how we are assuming that. So we got the formula over here. Now we have to find out one by one. Let's see what is the receivables. If we go back to the sales figure over here, we are standing at November. Now these are all the cash flows that are coming in November. This is not what we need. We need, standing at this point in November, what are the figures that we are expecting to get. So based on the cash flow forecast, let's say there are different timing, okay. For October figure, we know that 40% came up in the next month. But standing at November, 50% of October is also pending, 10% of October is also pending. Correct? Now, standing at, let's say if we talk about September, we'll get 50% over here, no, 40% over here, 50% over here, but 10% is coming only in December. So that is also pending. For November, the whole figure is pending because 40% will be here, 50% is here, 10% is here. So standing at November, September's 10% is pending. 40, 40 and 50. Yeah, September's 10% is pending. October's 50 plus 10, 60% is pending, and November's 100% is pending. So these are the figures we have. So receivables, September 40, 40% in October, 50% in November, 10% in December. So September 10% is pending. October 40% will come in November, but 50 is in December, 10 is in January. So 50 plus 10 is 50% plus 10% pending. And November, 40 is in December, 50 is in Jan, 10 is in Feb. So all amount is pending. So November 100% figure is pending. So we can take from the original amounts and multiply it. September, where is September? September total sales were equal to 2.9 million, and 10% of this is coming later on. Similarly, if we take October, October total sales is 3.3 million, and out of this 60% is coming after November. Then for November, it is the 100% figure, that's the entire 2.8 million. So the total receivable will be equal to the sum of these numbers. So that is sorted. Next, we need the cash balance. Cash balance is straightforward. We have the forecast already. For November, the closing cash balance we will have is 679. So we'll take this as it is, 679. So that is also ready. Then we need the payables figure. Now what we have multiple payables over here, so you have to be careful. First is about purchases. What was the purchase information? Was just that payments are made 2 months later. So if we talk from now, standing at November's point of view, this is the cash flow we are getting, but these are the payments that are pending. Now we made the purchase on October, but we are paying in December, so that is a payable over here. How about September? September is paid by November, so that is no more a payable. But 1120 is a payable, 1240 is also a payable. So October payment and November payment is pending as of November related to purchases. So related to purchases, October 100% and November 100% is pending. So that will be equal to October purchase was 1120 and November purchase was 1240. So that is ready. Next thing is what is the next title? Fixed cost. They told already it is paid in the same month, so no payables over there. Labor cost, 80% is paid every month, but 20% is paid in the following month. So if we talk from November's point of view, cash outflow, let's say if September, these 3 months will be mainly contributing into November. So September payment, 80% is happening here, 20% is happening here, so that's clear. October, 80% is happening here, 20% is happening here, so that's clear. November 80% is happening here, 20% is happening in the next month. So 20% of the November labor cost is what is payable as of November. So labor cost will be November's 20% payment. So November pay figure, where is November? November is 305 multiplied by 20 percentage will be 61. So here if I take the total of the payables, this will be equal to the sum of all these numbers. And now we have receivables, we have cash balance, we have payables figure. Just write here total. Total payable. Total receivable plus cash balance, that is equal to 679 plus 5070. Total receivable, total payable. And if we do the quick ratio calculation now, quick ratio hence will be equal to total receivable plus cash balance divided by total payable, that is equal to 2.37. Oops, bad idea. I took the wrong thing. Okay, fine. So with this, we are done with the 10 mark calculation for this particular question. Hope you have followed all the way till here. Now we have 10 more marks in this particular question. So let's move to next one. Question is asking, discuss two ways in which cash management of the company could be improved. So 4 marks it is. So they're asking how to improve the cash management. Now from the case study itself, there are some indicators over here because this is case study specific. Okay, they asked about how this company can improve it, so be specific over here. Let's say they're telling these subsidiaries are looking after their own financial affairs. So, and they told that this cash flow forecast is ignoring the cash flows of other foreign subsidiary. They told that this company is having, surplus in some months, and they have cash flow shortage in some months. That is maybe because they're considering only about their company, and all companies are dealing with their own cash management. But if these figures were centralized, if all the money from different subsidiaries are managed by a central treasury department, then what would happen is, if one company is having or one subsidiary is having a cash surplus, this can be transferred to the cash deficit company. So without having any extra borrowing or extra liabilities, money can be transferred between the subsidiaries itself within the group, so that cash can be managed effectively over here. So this can be one explanation we can give. Since it is for only 2 points they need, and this is for 4 marks, under each heading we have to give 2 marks worth of content. So first one, central treasury cash management, or central treasury department, anything can be done. Currently the foreign subsidiaries are managing their own cash figures. This can be changed to a central treasury department, hence central department. This will enable the company with uh, this will enable the surplus cash within one company to be transferred to another company within the group with cash deficit. Hence, this can help in avoiding cash flow shortages and meeting the requirement without having the need to individually raise external cash, meaning they don't have to raise a share issue, or they won't have to go through raising a liability. All that can be avoided. So we need one more point. Let's say this, we told about this cash flow between the companies can be sorted out. One more point. So let's say one good thing about central treasury department, let's go back theoretically what we learned with central treasury department. Because money is stored in bulk with that one department, they will be able to, if in case they want to borrow, they can assess the deficit in every companies and borrow in bulk. And at the same time, when lot of surplus is there from every company, they can go and invest in bulk as well. So investing in bulk will give lot of interest return, borrowing in bulk will get lower interest return. So this also can be one point you can mention under central treasury. Central treasury also also makes way for smaller interest rate on bulk borrowing, while higher interest rate on bulk investing, which individually companies will not be able to obtain. So that is enough. Second point we can say is, at last it was mentioned somewhere, company has no short term investment and has a policy of not investing the short term cash surplus. So they're just being conservative, they're just keeping the money over there. So you can just give the flip point. You can say that company can consider investing in cash, short term investments during times where surplus money is there. So they're going to invest in certain products that are for short term, like there are short term treasury bills. So you can just give one example of that. Then you can say that company should avoid from investing long term, because this is about short term cash surplus only. Second thing, you can talk about risk management as well, meaning when you're investing into short term also, you have to consider the fact that money can be withdrawn easily and there is no penalties for early withdrawal, and high returns are there, low risk is there. So you can give all these points in order to crack that particular marks. So the point was about short term investments. So company currently doesn't invest in short term investments, okay. Currently doesn't invest in short term investments. They may consider utilizing, hence they are focusing on liquidity. However, company may consider investing the short term cash surplus into short term investments. Company may consider investing into short term investments when surplus cash is available. These must be considered based on various factors, like any immediate need of finance, because if surplus cash is there but some immediate other finance need is coming up, you should not go and invest somewhere else. You need that money with you, so you have to consider that immediate need of finance in near future. Then penalties for early withdrawal from investment. Then return rate, risk involved, etc. Hence the company may consider investing in products like short-term treasury bills. Treasury bill is from government, so anyways it's risk free and it is for short term as well, so both problems are sorted. So this should be enough for our 4-mark question over here. Now we are done with 10 plus 4 14, so we have still 6-mark question left. Let's move to next one. Explain the motives of holding cash. Now they didn't specifically mention what is the motive of holding cash for this L company over here, so this can be considered as a general theory question. And how much marks it is? 6 mark. So that should be the last question over here. We know theoretically motives for holding cash is 3. There is a precautionary motive, that is you're keeping it for emergency. You have transactionary motive, that is you're keeping it for transaction purposes. And you have speculative motive, that is you are keeping cash for investment purpose. So 3 things are there. These 3 things are what we have to say over here. So number 1, transactionary motive. One primary reason for holding cash is to meet day-to-day expenses of the company, that is transactions. Now we told the definition of what is transactionary motive. We need 2 marks, so we need one more point. How can company know, let's say, how much money to keep with them for transaction purpose? They can see past history, how much transaction happens on a daily basis, or they can create a forecast for the future like a cash flow budget and all. That will also give them an idea how much transactions are going to come up. So based on past transaction history and future cash flow forecast, the amount of cash needed for transaction purposes can be estimated. That was just to add one more point because this is a 6-mark question, so we need 2 marks for everything. Second issue was about precautionary motive. Precautionary motive means holding it for emergency. So cash balance is also held in the company for company as a precaution for any unexpected events occurring, like emergency. Now how to know what kind of emergency can come up? There's no, you can't predict what emergency will come in future, so definitely doing a forecast for future, there's no idea. So what you can see is based on the past history, just see what all things have been coming up, see what chances are there these could be repeated in future, then do an estimated calculation and keep some amount of money like a buffer cash, like a bulk cash over there. So company can analyze the past unexpected payments that have occurred, analyze the possibility of this occurring in future, and based on other industry or on other company specific situations, estimations can be created and a bulk and a buffer cash can be stored within company. Okay, so that is over. Then finally about speculative motive. What is speculative motive? Trying to seize opportunities, whatever investments and all are going to come up. Speculation is about anticipating that future investment opportunities may arise, and in order to seize these opportunities, cash balance is held safely within the company. Now, how do they know how much to keep for speculation specifically? It is based on how much they want to invest and what is generally the situation going around the industry. Based on past, there is no point in looking at what investments opportunity will come in future. Past was past. Maybe based on what cash surplus you have to decide how much I want to invest out of this. What amount of risk am I willing to take? Based on the industry standards or situation that is going on, what all possible investment opportunities could come up. This could be a study to understand how much speculative cash is needed. So, company can companies must analyze the industry and business situation, amount of investment and risk willing to involve in, and based on that, cash for speculative purposes can be kept aside. This generally will be considered the last of three motives of holding cash, because first you have to remain liquid and you have to be conservative. Your company should be in a stable position. So transactions you have to meet, emergency situations you have to meet, then only you will think about growing money more by investing somewhere. So speculative motive will become the last of all these three motives. Transactionary and precautionary is more important. So with this we are done with this particular 6 mark question, and we are done with the question number 2 of section C, which was related to working capital management. Hope you have followed with this question and followed the ways on how we have broken down the question, and in the previous question how we have made that cash flow forecast and the simple layout to follow in every cash flow management question as well. So see you soon with the next question.